Hey everybody, David Skarica here, stock chart of the day. So we see this gold's up to, you can see 21.41, 21.42, was high as 21.44. So the private payrolls came in weaker than expected. So that may mean that this Friday, the jobs report for February could come in weaker than expected. And if that is the case, that's good for probably risk on assets, good for precious metals. I've talked about a million times. So early on in interest rate cycles, gold tends to do very, very well. So, it tends to do really well. The in those cycles. And of course, and I think the Fed will cut 3 to 4 times this year. So, one of the things we've seen is that gold has kind of tracked interest rates for the last few months. So, gold kind of bottomed here in October, a little before. It's never going to do it exactly the same. And when you see the TLT went down to 82, and that's when rates spiked up over 10% on the 10-year bond. So we're just going to get, it's going to get like a 2-year chart. So you can see this move up, down and up. So you can see the move down when the Fed was raising rates the last 2 years, and then the bottom and here. So this looks to me like, I think we're in a cyclical bull market. So of course, a secular bull market is a long-term bear market. It's a long-term move, like the last 10, 20, 30 years. I still think we're in a secular bear market for bonds, but I think we're in a cyclical bull market, which, could see the yields, maybe fall to 3% on the TLT on the 10-year bond, et cetera, et cetera. So if we look at this, you can see the rally was from about 82 to about 100, so roughly 18 points. And then we pulled back to about 92, 93. So it's roughly a 50% retracement. And it looks like we've kind of got this bottoming formation here, and we could see the next move higher. And of course, that will put a lot of relief in some sectors like housing, because, you've got this high interest costs combined with high housing prices. Should help the precious metal stocks. Actually, tomorrow's stock chart of the day, I'm going to have a very, very interesting chart on, even though a lot of aspects of the market are frothy right now, with a lot of these crypto coins moving, and of course, NVIDIA and AI boom. But there was a sector that actually started to break out, and it probably wouldn't be breaking out if we were about to enter a bear market. And I'll talk about that tomorrow on Thursday stock chart of the day. So again, we can see the TLT here and this move. And I think this was just a pullback in a cyclical bull market, like a bull market that should last until the end of this year or even into next year in bonds, and we should see the yields come lower. So we're going to look at the TNX, and we'll see that as well. You can see the TNX here. Yeah, again, it looks like we had this little move higher to 440 on the 10-year bond after falling to 380 from 5%. So again, it falls 120 basis points. It goes back up about 60 basis points. And now I think it's going to probably move lower. And like I said, I could see us in the 3% range as the Fed begins to cut rates here in the coming months, et cetera. And I think that like the inflation is going to like basically bottom between 2.5%, 3% here. So it's another reason maybe the 10-year bond could fall to 3%. And we must remember the interest problem that the U.S. government has, the debt it has. That, for example, if you're paying, when they were paying 2% on the government debt, let's say, and the debt was, say, 30 trillion, let's just make it easy. 2% of 30 trillion is 600 billion, right? And the budget of the United States is about 6 trillion. So 10% of the budget is going towards interest. At 5%, if all that debt gets rolled over at 5%, then you're talking 1.5 trillion. And of course, the debt is going to move higher. So then you're talking 25% of the budget goes towards interest payments. So I think one thing that no one's talking about, one of the reasons the Fed kind of knows they have to cut, is because of the government budget imbalance is becoming so large. These interest payments are going to eat up too much of the federal deficit. So anyhow, this is again the TNX. You can see rates. It looks like to me that rates are going to be moving lower and bonds higher in price. And you can see this is the 3-month Treasury. So this has come off its highs, but it's not really discounting rate cuts yet. It probably will start to do that, I would think, in the April-May period. So in a month or two, you'll see this start to come down because it will start to anticipate rate cuts. Like if we go look, let's go back to 2019 when the Fed cut rates. I think they cut in June. And what you'll see again, look at this kind of April-May period in 2019. Let's just look at 2019 for that reason. 2019, we'll go start in March of 2019, and we'll go to here. So you can see it's 2.4%. And then you can see the move lower into June, and that's when they started the cut rates that year. And you can see it started going lower in May. So I guess it might be May, but still, it looks like we'll probably start to move lower. And again, the thing I want to show you that I find quite interesting about this is I think the Fed's funds rate was might have been it was 225. Yeah, it was 225 to 250 at that time. And they cut it to 150 by November. So they cut it 75 basis points, roughly, right? And they cut it 75 basis points. And the market boomed in 2019. We'll go look at the market here. See, S&P roared. And then we can see gold did very well too. And gold had right when these interest rate cuts started, gold really took off. Looks like this time actually gold is starting to anticipate these even a little more. So anyhow, you can see gold did fabulous, going from under 1,300 to over 1,500 during that interest rate cut cycle. So and actually, it looked like after that November rate cut, they were going to actually start raising rates, and then COVID happened, and they cut rates to zero. So I think when you saw this decline in September to whatever November, the market was actually anticipating that November would be the final rate cut. So maybe November should be the final rate cut this time too, November or December. So maybe we will see a similar move if we see this huge move in gold, which I think we will see into the summer. Maybe we will see a pullback in the fall, anticipating rate hikes. And I just want to end off in this note because I'm talking about interest rates. I think at some point this whole thing where gold sells off when they raise rates, and it did it a bit in 2018, 2022, gold was flat. That's going to end at some point if you have some sort of sovereign debt crisis. Again, if these interest rates go up in the next cycle, it's probably a few years out, and the government is having now problems with its budget because the interest payments are so large, I think gold goes up in that scenario, not down if rates go up, because the government is becoming insolvent. So that's today's stock chart of the day. It looks like bonds have completed this kind of pullback. They're starting to move higher. Rates are starting to move lower. If the jobs report comes out weak on Friday, or just in line, I think that should help even more. And again, the private payrolls did come in weak today. So everybody take care, and I hope you have a great day.